Hello everyone. Yes, I saw one little comment in there already before I went live. Yeah, we are here and we were just setting up everything. Good to see you, and we are going through our weekly commentary. So, as of always, you guys can ask me any questions in the comments on YouTube. I'll answer them the best of my ability on a live basis with what I've got. And you can ask about options, macros, environmental types of things for trading, risk returns, risk management, all sorts of things. So the floor is your guys's for sure. Anyone that's here live, and I will of course just answer some of the questions that have sent to me over the week that I think is kind of pertinent, and we'll just talk about those things as well. So like I said, if you guys throw up anything, I will answer it as it comes. Now, first and foremost, let's talk about what has gone on in the weeks kind of leading up to this, and as far as in macros, where we are, kind of touch base on where the market is in general and where things are at. So this is the net percentage of domestic banks tightening standards. This is just for those of you guys that might not know what this is. This is more of our banks becoming, are they easing? So is it easier to start getting loans? Is it more of an expansionary time frame, or is it more of a contractionary time frame where they're not wanting to lend as much? And typically, if you don't lend, capital dries up. So what capital? Basically, working capital, like. If someone wants to expand their business, they take out a loan, expand their business. That creates more revenues and more profits, so therefore they pay back that loan, and then they do it again, and they can expand. It's really hard in general to expand businesses without getting capital first. So it slows down the process, and what ends up happening is it creates a economic contraction from that. So we saw that in COVID, right? That's what the COVID spike is. That was very abrupt, quick economic contraction, and then they eased off very quickly as lending standards dropped and reserves went down to zero, all sorts of different things. You can see this in 2008. You can see it in .com. You can see it even going into the early 90s contraction as well. And if we saw it back in previous recessions, you'd see it there as well. So it kind of rinse and repeats. So where are we at right now? Well, the juice from the COVID ended up kind of drying out, and then now we're in this tightening process, and that's because of inflation, raising interest rates to try to stop all that. This last one that just got released for Q2 is basically saying that more banks are tightening. So it has not actually started to go the other way. Now, less banks as a whole are tightening, but keep in mind that in order for this number to go up, it's got to be pretty aggressive. I mean, the very top side of this scale is 80% of all banks. And right now we've got 46.7% of all banks are tightening lending standards rather than easing. So keep in mind that this is getting a little bit worse, not better. That doesn't mean that we're necessarily in a bear market. And that's probably the question that I get the most, because a lot of our stuff actually comes back to, hey, are we in a bull market? Are we in a bear market? Are things going to go up? Where do you see the markets, right? In general, we got a lot of different systems. So we've got option systems that really don't even care about the direction of the market. And then we've got things like macro portfolios that are kind of agnostic, but in general will set up for either a bull or a bear market. We have been set up for more of a bull market for probably 3 months now. That, is that a bull market or is it a bear market rally, right? That's kind of where things end up going. So the deal is there are macro indicators that say we are in a bull market, but there are also things saying that this is a contractionary time period. So the thing that I would probably reference to the most is here. I can pull this up really quick. Yeah. Let me pull this up really quick. So the thing that I would reference the most on. So this is, I'll explain what this is in just a second, but this is the S&P 500, which is the dark blue back here. And then you've got orange, which is the inflation rate. And then you've got this teal color, which is the federal funds rate. So just imagine this is like these two components back here, this inflation and the federal funds rate, really does dictate quite a bit of the monetary policy. There is another factor in here that would be growth that I'm not looking at right now. So that's another variable that will be in there. And then there's also one more variable, which is relative inflation rather than CPI inflation. I'm not going to get into all of those crazy details right now, but we are going to talk about what an inflationary recession looks like versus a deflationary recession. So first, let's go through what a deflationary recession looks like. These are probably going to all stick up in your head really easy because we just had two really strong deflationary recessions. By the way, deflationary recessions are typically deeper and have longer bull markets also. So here's 2001, right? So there's that recession that lasted for, roughly speaking, 2.5 years. Here's 2008 that lasted for about a year, right? As far as from peak to trough in the actual stock market, right? Now the recession lasted much longer than that, but the assets actually started recovering prior to that. Now, what happens in an inflationary recession or in a deflationary recession? Typically, inflation is rather in control. Yes, the Fed might be raising interest rates. Yes, everything like that. But inflation isn't exactly like out of control, out of this world. It's normally hovering just a little bit above target. Let's call it, 4% or maybe even 3%. And you can kind of see that prior to the 2008, we kind of had, 4.21. Nothing too extraordinary for inflation back here, but something that, it was creeping up there. But eventually you get this big crack, and that's when all of a sudden the contraction in the growth starts to really pull down assets. And then what happens is the Fed ends up, in order to kind of spur everything back up, they start dropping interest rates and starting to print money and try to spur that inflation back in and to get the economy growing, right? So that's what happens in both of these recessions. It's a cycle. It takes a while. There are rallies inside of it, but it does take a while. Totally different than an inflationary recession. An inflationary recession is like something that happens in the late 60s and 70s. So in let's just talk about the 70 contraction. So the stock market's all doing fine, everything's doing hunky-dory, everything's going great. But all of a sudden, inflation starts to go beyond a level that is relatively in control. Basically, what happened is the market became too hot. And we get a inflation that started to creep up to, as you can see back here, about 5.6. So that's far beyond that, 4, maybe 3.5 level of what typically sets up for a deflationary recession. So that's when the Fed really has to start hiking rates. Really, the monetary policy starts to get really tight. And that's typically when you start to get the dip, right? It's because the monetary policy actually is what's creating the recession, not necessarily a slowing growth creating the recession. In fact, the growth is there, but what's stopping the growth is actually the tightening of monetary policy. And that creates this quick, kind of push down that you end up getting. And then inevitably inflation starts to roll over on its own, right? And as inflation starts to roll over, so now keep in mind, the assets are falling as the Federal Reserve is tightening interest rates still, right? They are tightening down as the market is rolling over. Very different from the Federal Reserve dropping interest rates while the market is falling. So let's go to 2001 and 2008. Market starts dropping. What does the Federal Reserve do? Remember, they're teal back here. Market starts dropping. Boom, they just start dropping, right? Deflationary recession. They're trying to spur inflation. Here is another one. Market starts to drop. Boom, they just start dropping dropping their interest rates. They start to, try to stimulate the economy. Go to inflationary recessions. They're tightening. And then finally, when inflation starts to cool off, they start backing off, right? They start backing off when inflation starts to peak. Boom, you start another little bull market, right? Then inflation starts to crank back up again. What does the Federal Reserve do? Dang it. Start tightening again, and it creates another contraction until eventually inflation starts to peak out again, and then they can drop it again and then try to spur economic growth. Now, this is this boom-bust cycle. This Federal Reserve is attempting not to go through these boom-bust cycles like what happened in the 70s, so we'll see how it all transpires. Let's look at what is going on today. So, today, market going up, inflation going up, Federal Reserve way late to the game, by the way. Way late to the game. We talked about this back in the end of 2021 when I was warning everyone that was actually a part of the services. We got something coming, people. So we were talking about that they were late to the game. Inflation was way too high. Boom. They start raising interest rates. We get a contraction, right? But they're raising while we're getting this contraction in assets. Then what happens, right? Let's look at an inflation recession. When does the bottom get set in? When inflation rolls over. That's the bottom. You get a rally. When inflation starts to roll over, boom, right here, there you go. You get a nice bull market again, right? Now, this last cycle was a little bit unique because we had such high inflation that it actually started to keep asset prices elevated. So they weren't able to contract as much as they normally do because we basically had like a 15% inflation. And so the market, it's really hard to get a market to go down 20% when inflation is devaluing it by 20% in that same year. The market stays really flat, right? So high inflation actually can keep markets from going down just because the currency itself is getting wasted away behind it. So where are we at? We're rolling over in inflation. The Fed theoretically should actually, if we're doing a boom bust cycle, the Fed should actually roll over these interest rates, or should have already basically started at this point. They're not. They're holding it steady. They have not raised interest rates today because that's what happened today. So they're pausing. So we'll have this pause. Now, will they start contracting? The market is pricing in that they will contract. Let's go take a look at that. The market, we can pull up a nice little website here, which I will give credit to where credit is due, the CME group over here. So the market for this next inflation rate cycle, they are basically saying that we are going to possibly go up by another basis point next meeting, but there is a potential that they won't, right? Then let's go out to September. What are they going to do? It looks like if they raise interest rates, they're going to pause again. November, pause. December, dropping, right? So just FYI, my economic models show that we are going to have a fantastic third quarter as far as economic growth. I'm not saying that stocks are going straight up, but we should have a nice economic growth in the third quarter. And inflation should be relatively under control, which should be bullish for stocks. Fourth quarter is a totally different story, right? Fourth quarter is going to be very contractionary and could be relatively painful. And then the first quarter of next year is also going to be a little painful as well, because actually the first quarter of 2024 is projecting out that we are going to get a re-acceleration in inflation. And that is normally a cause for a retightening of interest rates, which would actually create a pretty deep recession at that point. It's a long way out, so models can change very dramatically, but I just kind of wanted to let you know kind of what's on the horizon, and then we'll go from there, because that is what I get asked quite a bit. So That's where the kind of rate hikes are going from there. And then you can kind of see they're thinking that they're going to hold steady. And then they start dropping pretty dramatically in March and in May. There's a pretty solid drop over the first quarter of 2024, which is kind of how I'm projecting things as well. I think, 450. And then we basically kind of hold steady out there. Now, granted, when you start going out this far, the market is pricing in a certain amount, but they're not fantastic at it. Something to kind of keep in mind here. So here's a pretty deep interest rate cut right here. Keep in mind is that when we're looking at November of 2024, there's a lot that happens between now and then, right? But it does look like there is a recession on the horizon, but it is going to be first quarter or maybe a little bit of this last quarter of this year. Until then, though, everything should actually be really nice and peachy. So that's kind of hopefully that answered that question that gets sent to me. Now, as far as GDP growth, like I said, that is basically aligning with what we saw. So if you go to GDP Now or the Fed GDP Now forecast, they're showing that it's positive growth as well. That's where we are. We're basically right at this 2%. They're a little bit above 2%. We'll see where they're at in the third quarter. That doesn't actually start showing up here soon, but we did have a nice solid quarter last quarter. All right. Now, the other question that we get is, how are we performing, right? So here, I can pull this up because we've actually just hit a little bit of a milestone today. It was really nice to see this. So let me get to our website. So if you go to our website here, Environmental Trading Edge, you can see all of our products and our adapt options, and you can kind of go in and learn more about these things. But I get asked about results all the time. You can always click on our results. This is public. You don't have to log in to see any of this. You can just see how we are performing. So these are all of our different strategies. These are by years, how they've performed. And then you can see that this is by month when they were available, right? So the one that hit the milestone is we finally hit over triple digits this year in our Adapt Intraday. Now, our Adapt Intraday is an intraday trade. So you have to enter it relatively early in the morning, and then you've got to monitor it. So it is definitely an intraday trade. But still, we're nipping at the heels at about, half of that return in the Adapt Dailies. That's a check it once a day type of thing, basically at your leisure, whenever your trade time is. But it's doing rather well as well. And then, of course, the Awake portfolio and the Sleep Well portfolio, that is a leveraged long portfolio. It's up 15% for the year, so it's doing great. And then the Sleep Well portfolio is up about 5% for the year, roughly speaking. The Awake portfolio can do about 50%. Clearly, you can see back here in 2020 when it was having a heyday because it had a really quick macro cycle. So we had a lot of edge there. Both the Sleep Well portfolio and Awake did really well. But remember, the Awake can leverage up to 3x. So yeah, doing fantastic. And we did hit, like I said, that milestone of 100%. We've had a solid June so far, and it's not even over. So we'll see where everything pans out. Things can get better, things can get worse. That's just part of trading. By the way, something that I always get asked is, okay, great, you're up 100%, but how much did you risk? Well, we we have an allocation type of process. So every single trade gets a certain amount of an account size. This is at level 3. Level 4, which is a very, very aggressive allocation at a point where you're risking 50 to maybe even 70% of a trading account. Very aggressive strategy. That thing is up about 390% for the year. So significant more risk, but it has also taken, like I said, it also has taken about a 35% drawdown to do that 390%. To do this 100%, we have drawn down about 13%. So we drew down 13%. I want to say it was I think it was in January, actually, when we took that drawdown, and then we popped out of it in February. We also just got over having a 12% drawdown here in May. That's actually what got that number a little bit lower, and then we popped out of it, and we've been having a solid month as well. That's typically how these strategies work. You go through some lulls and then you pop out of them and you do really well. Same thing with the adapt dailies. We actually were running this since December. We didn't have it publicly available yet, but it actually had a little bit of a lull in January and then popped out of it with a 34% month. So it was actually really nice. Yet again, 2 months of relatively low returns in March and April, pop out of it with a 6%. And then, here we are just a little bit drawn down in June, and we'll see what ends up happening at the end of the month. Okay. Intraday calendars are doing amazing. Thanks. When Adapt Advance will start to perform. Oh, when will Adapt Advance start to perform? When it works, so it's something it's very rare that the Adapt Daily type of methodology beats me. So just know that the Adapt Advanced, those are my personal trades that I use the Adapt Advanced metric and the systematized process to build a trade around. So they're my personal trades. That whole system is very fluid. You can do with it what you will. What I will say is that the last couple months I've been somewhat defying the metric, and it's burned me every time. So that's my own deals. So hopefully the whole thing is that everyone in the system is watching how I do things, seeing where my missteps are, seeing where I get things done right. And if you do follow the process, it's actually been doing really well. But I do post my personal results and my personal trades and from my account. So hopefully it'll perform this month, and we'll go from there. I got asked from some of the members to actually keep on my last month's trade. So I kept that a little bit long, more so than I like to do. I normally like to let those go and then go into the new strategy. Something to note about the Adapt Advanced is that it does have higher upside. So there's a little bit more volatility in it in general. That's why you can see, we had a 12.5% down month. Granted, the Adapt Dailies can also pull down about 16% from their high water. So keep in mind that they haven't, but keep in mind that they can be drawn down as well. But the Adapt Advanced normally, on a really good month can perform. So the highest I've ever performed in a month was about 90% in a single month. With that, pull that back from expectations though. Generally, my good months are, 30% or so. Whereas, 30, 40%, the Adapt Daily can clearly do that. You see it did 34 in January, but it can go a little bit higher as well. That's pretty much probably its highest performing month that you'll ever see in the Adapt Dailies is 30%, whereas we can get up to 60 and 90 if things really work out really well and we start to string together a bunch of trades that win. So just know that the way the Adapt Advanced works is like you kind of work into this, the market will kind of not work with you for a little while, and then all of a sudden, boom, just everything just kind of clicks into place and just, and you just start making a boatload of money all of a sudden. So that's just kind of how it feels. So nice question, man. We will work on it and we will perform very well eventually. But hopefully, like I said, the classes and everything, it changes your mind about how you look at markets. It's how I look at markets. As you guys know, there's lots of different ways that people approach markets. The way I approach them is through an environmental metric. I share that environmental metric, or at least the output of that environmental metric, through the Adapt Advanced structure and the Adapt Advanced service. Whereas the Adapt Daily, you don't really see what's going on, behind in the mechanisms of everything. And, that's good and bad. Some people love that because it doesn't cloud everything. But some people, their goal is not to just make money. Their goal is they want to learn. And learning is the utmost importance. There's a lot that you can learn from the Adapt Daily. Position sizing, consistency, things like that, right? Like there's, and it's much more a done for you type of system. But there are some that reach out to me and, sometimes are upset because they want to know what my models are. and those are proprietary. I do keep those behind closed doors. I do get asked why. Well, I set this up as a business, and the way businesses work is that you do have to maintain your edge as a business, just kind of like a trader, right? And in order for me to maintain my edge, there are just some things that I can't give out, because then eventually then everyone has them, and then it changes, and then someone steps on the edge, or then it stops becoming valuable. And then eventually what ends up happening is you start losing customers or clients at the end of it, and then the business can't exist anymore. So then no one has the product, right? No one has the ability to go for it. So the way that this works is it protects everyone to make sure that there's a nice trading strategy that everyone can use, and there's a nice consistent little business back here, and it works out really well. So yeah, ups and downs, left and right, but there is a consistent approach back here, and this is how I've been trading for many years successfully, and so you guys can share with it and be with me on the journey, and hopefully learn a lot from it in other ways other than just knowing what my model is. So yeah, let's see. Trading returns are usually lumpy. It's normal. Yes. So actually here, I'll give you guys a little sneak peek here. Where am I showing here? There we go. So let me, here, I'll push you guys over onto this, and then let me log in here. So if you go down to the Adapt Daily, I'll be putting this on the other ones too. It's just small things. I'm actually bringing on someone to help kind of clean up the website just a little bit, and bring everything to where it's just a little bit more user friendly. But until then, I at least got this up here. Here's the Adapt Daily Indicator. So share this tab. So as you guys see here, this is the Adapt Daily Indicator. Probably if you guys are seeing this, you guys are probably somewhat part of the service. If you guys have any questions, by the way, I can answer them here. But here's a buoy. This is what the trade is. Here's the different risk levels as far as what your allocation should be. Here's your CAGR that is, relatively expected through history. And then here's your max drawdown that we've had so far. Here's your returns. You guys can always see that. And then right down here below it, you can see what our individual trades has been and where they're at. But then down here, you can actually see our little equity chart. So I make sure that this is plotted, and basically anytime we put in new trades, it'll automatically update, and you can see the performance. You can see as soon as we started the service, we actually had a very stellar time. And then since then, it's just been nice and steady Eddie, right? Kind of doing its thing. Keep in mind, so we had a drawdown here, but keep in mind that at this risk level that we're using right now, it can have about a 16% drawdown. And I believe we are only, we're probably only at like maybe a 6 or 7% drawdown right now. So we can go down a little bit lower, but statistically we're more likely to go higher than we are lower. So that's kind of a positive thing as well. Thank you. Greetings to you too. And it's been doing really nice and well. I'm really glad that everything's working out well, and clients are in general really nice and happy and satisfied with everything executing. I know we were getting a lot of questions when we started to have kind of a general amount of people showing up. But then even with new people showing up and joining the services and everything like that, really the questions have been pretty minimal. So that typically means that everything is explained really well. But of course, we'll see how it goes as I get another flood. Also, by the way, the service gets better just as it kind of continues to grow and more people use it. So if you know of someone that can use the service, go for it and let them know, or not, keep it to yourself. So it works out both ways. All right, guys. Well, I really appreciate all of the positive feedback. Seriously, it's really great to hear that. It means a lot. The whole point of actually starting this whole service was to not just trade myself, but to actually help out the whole retail trading type of methodology that was out there. For a little bit more about the backstory for me, I started out as a retail trader. I joined a hedge fund. I learned professional trading, and then inevitably, started to just trade individually again, away from the hedge fund, and coming back into kind of seeing what was out here in the retail trading land. There is lots of things that are just massive sinkholes that aren't talked about and aren't emphasized. And I think a lot of it comes down to it's just not spicy, like everyone wants to hear about this sexy new trade that is, making lots of money right now. We could post that, as soon as we have like one winning trade, like today's calendar, or the fact that we've had 10 or 11 intraday trades in a row win. We could be like, look at us, we're on pace to do 1,000% this year, because that's kind of what grabs people's attention. But the thing that isn't pushed or really emphasized is risk management. And I know it's like risk management, of course, don't bet at all. That's normally what everyone says, right? But the point is actually that depending on your edge, right? Depending on how strong that edge is right now, how strong the trade is, how volatile the trade is, all of that, right? That dictates on, how much of an account can you risk. Like for instance, in the Adapt Daily, right? We've got, roughly 7 trades. I think it might be 6, but we've got there's tons of different variations of those trades as far as their risk parameters. But as far as the structures are concerned, that's what we're talking about. Each one is unique in their own right per their environment, right? In an environment when the buoy kicks on, right? There's some buoy environments that you can risk 20% on that trade, and there's some buoy environments that we can only risk about 5% on that trade. Well, if you risk, if you're risking 20% on a trade versus 5% on a trade, and you've got both of those, allocated at, let's say 50%, or God forbid someone's putting 100% of their capital or that little trade, that little account, like a trading account in it, and hoping that both are going to perform the same, one's going to have way more weight. So even if you had the same probabilities, just the risk reward is going to blow up the account. I talk about that a lot further, and I have talked about that a lot further before. But anyways, that's a lot of what I wanted to start sharing and make a system that was very clear and concise about, okay, this is as much risk as I'm putting on. And then, everyone can just choose to do what they want with it, right? I'm definitely not telling anyone to trade any certain way. I'm just kind of showing what we do and what environmental metrics I use and what trades I'm entering in. And then, everyone can do their own thing. So I'm really glad that it's working out for a lot of people. And I just went on a rant there. But anyways, I get a little bit passionate about the fact that I just see a lot of people getting excited about certain trades that are out there that have been working for 6 months or so. And it's like, well, yeah, it's been a great environment for that type of trade setup. And then all of a sudden they all get in it. Everyone buys these services for, $300 or $500 or $3,000. I've seen them for all sorts of different levels. And then all of a sudden, 3 months down the road, it blows up because it doesn't work anymore, because it's a different environment. Of course, it's not going to work anymore. That structure doesn't work anymore. But it was working for the last 6 months. What happened to it? Well, that's what they don't explain. They don't explain that there are environments, there are ebbs and flows in the market, and not every day in the market is the same market. And that's mind-blowing, I know, for a lot of people. The fact that not every day is the same day. Honestly, October of last year versus today in the market are black and white. They are so different. You've got to handle risk differently. You've got to handle allocations differently. Structures are different. Everything. It's amazing. What are your further plans for new services? That is a great question. So as of right now, in the background, I am working on a long short portfolio. Lots of people have asked for that, and I do need to get working on that again. I actually had it about probably 80% of the way there, but yet again, compiling it into a service, that's something very important. On another note, as far as options are concerned, there are a couple other, intraday options that I've got in the background back here. But one thing that I keep on, the whole thing is the more people ask me for something specifically, the more that it's like, okay, that must be like the thing that everyone kind of wants right now. So I'll work on that, right? Something that does keep on getting asked is a more simple, clean option system, kind of like Adapt Daily or something like that, but they don't have to check it every day, right? Some people, their work is just a little bit more invasive, so that they can't actually get away for a lunch break to execute something like that, or they don't feel confident enough to actually execute a trade as complex as say something like the deep sea or the reef trade or something like that. And so I'm working on something like that. Also, there are some brokerage accounts, some brokerage account styles, like margin accounts that aren't margin, say they're cash secured or something like that, that don't allow you to do calendars. So I know I've had some requests as far as, hey, can you give me a simple option strategy that makes, a good solid 20, 50. I mean, of course, if we could make 500%, that'd be a great too. But that is a little bit more like laissez-faire. I don't have to manage it as much. And maybe I can just set up like, good till cancel orders type of things, and, management after I get home from work. So that's probably going to be something that I'd look. The way they execute is perfect for me. Keep it simple. Yeah. Yes. See, yeah. It is about the simplicity that everyone likes. I'm really glad that that was the whole point. Was we didn't want heavy adjustments, right? Those of you guys that are part of like the Adapt Advanced, if someone's following my trades, it's just more difficult, because not only do you have someone executing a trade, but then you're like, oh, I've got to keep up with that so quick. I've got to execute that also. And really, the Adapt Advanced isn't designed to say, follow my trades. That's why I've never liked trading services like that. It's really designed to say, hey, this is the framework, set up and manage your own trades, and, you can use synthetic trades and stuff like that, and just try to work through it. That's kind of what that system is designed for. And there is a lot that I need to still get implemented in Adapt Advanced. There's some historical data that I need to get in there so everyone can, really go back and test a bunch of things, and then get it to where things are a little bit more streamlined. So there's a little bit of things that I want to do with the business as well. So I've got to bring in some help for that, and we'll get that going as well. All right, gentlemen, gentlemen and ladies, it has been fantastic. Thanks for joining, and we'll get this thing wrapped up, and I'll see you guys next week. Same time as always, 3:30 Pacific time. Be aware, I might move that up. It might just work out better in my life to move it to like 3 o'clock or so. But I'll see you guys there, and I'll see you guys next week. Good trading, and keep control of your risk, and I wish and pray all of you guys have lots of profits. Bye.